please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
That's a distance lower. It will be higher than Ekta's poll, but not by much, 8 basis points. But it's a distance away from what the Reserve Bank guessed. The Reserve Bank brought down its March 31st number from the earlier 5% to 4.5%, 5.1% actually, to 4.5, 4.6. But the number has undershot even that. So clearly we have, perhaps a softer trajectory lying ahead as well. With the permission, Soumya, that I will interrupt you, 4.28, your first comments?
I think it's a little higher than our expectations. So we were expecting it to be around closer to 4.1. So it's around 15 basis points higher than what we are expecting. Possibly, I mean, the impact of the lower vegetable prices has not been transmitted fully, and possibly you could see that getting transmitted in the next month, and that has been the trend I think we have been seeing in the last couple of months. So maybe it's because of that, and core I have not yet estimated, but hopefully the core should not bulge too much from the estimates which Ekta just gave out.
Okay, well, I have got the entire CPI release. Meanwhile, the IIP is actually as good as my friend tweeted, not 7.8, but maybe she said 7.2. And what we've got is a 7.1 number. So that's a fairly decent industrial output number that has come in for February. Since policy is more dependent on inflation, I'll go through those numbers first. 4.28. And the food inflation has come in at 2.8. So correctly, as Ekta was telling us, it is food prices that have come down substantially, and veggies in them have done exceptionally well in terms of a softer inflation. So what do we have? Cereals up 2.1%. So hardly any inflation in cereals. Meat and fish 3%, 3.1 to be precise. Eggs 7.47%, milk and milk products 3.5%, oils and fats 1.85%, fruit is expensive obviously at 5.78%, veggies, Ekta, it says 11.7%, but you are still right, because month on month veggies have fallen significantly. I can actually give you the number, just give me a minute. Veggies have fallen from an index of 140.5 to 134.6.
On a month-on-month basis.
Month-on-month. So you do the math, 140.5 has fallen to 134.6. So it's some 5% fall in veggie prices month-on-month. Though year-on-year, it still looks higher at about 11.7%. Because last year, of course, same time, post-demonetization, we saw a complete crash in vegetable prices. Then you have pulses, which are minus 13.4. Sugar, minus 1.6. And I think sugar will be minus for a long time to come now. Then let me just skip to food and beverages as a whole is 3%. Well, clothing is 5.1, footwear 4.29. So clothing and footwear together is 4.9. Housing is 8.31. So the effects of the pay commission is still showing. And fuel and light 5.7. Now come the services. Household goods and services 4.3. Health 5.16. Transport and communication 2.89. Recreation amusement 4.4. Education 4.5. Personal care and effects 4.57. So miscellaneous as a whole is 4.16. Before we come to the manufacturing, you would want to add anything, Soumya?
No, I think the surprise is the core part. The core number has gone up to 5.37. So that actually has made the spoil spot, and the numbers which you actually read out. So those numbers reveal that there has been some sort of an uptick in the core segments, even though the numbers are not on the higher side, but around 15 to 20 basis points higher than what the street was expecting. For example, the education component is one of them. But I believe that this could be a seasonality involved in some of these components like education. So that's actually the number which has pushed up the CPI higher than the market expectations.
Okay. Ekta, you wanted to add anything about the industrial growth estimates, or have you been able to open that?
Well, I'm still waiting for the press release for the
no, I have
IIP
got
data.
the industrial output number. Then I can perhaps enlighten you about what the numbers look like. Just a minute. This is again those telephones and all that which normally distort the numbers. 1 minute. Manufactured products is up 7.1. Where are we? Okay, 7.1 is the overall February growth. Electricity comes in at 4.5. So it's not a terribly good number. Manufacturing is coming in best, 8.7. That's really the clincher. Mining continues to be minus 0.8. So really it's flat, 0.3. But I think the clincher really is manufacturing at 8.7. Electricity is nothing much to write home about at 4.5%. And the overall comes in at 7.1%. I'll quickly tell you what we have in terms of primary goods and capital goods.
I have that data,
Sure,
Lata. The primary goods are 0.8% for the month. We have capital goods which have grown around 3.7%.
Ikta, I think is the previous year. You should be reading the other one, 3.7.
3.7 comes under capital goods. Any which way, go ahead.
No, sorry. Primary goods actually 17-18 is 3.7.
Okay, 3.7. Right.
Capital goods is 20%. Oh wow. Okay. I don't know if that's a base effect, but 20% higher. Yeah, there's not much of a base. After all those months were bad. They were all demon months. So it was bad. Okay, then we have 3.3% for intermediate goods. Infrastructure and construction coming in at 12.6. 7.9 I think is consumer durables and consumer non-durables coming in at 7.4. Okay, so not too bad. 7.9 and 7.4 are the consumer goods. But capital goods takes your breath away with 20%. Okay, that's all the numbers that we can put on your table. Well, what have you got to say, Tushar, of the industrial output numbers?
Well, inflation, we were at 4.3 and IIP, we expected a reading of 7.8. So I think both the numbers have come in line with our expectations. One main point on inflation is that, we are actually not surprised with the uptick in core. We have done some in-depth analysis on this front, and I think there's a contrasting difference as to what was happening with the core trajectory last year and this year. If we break down the core components, 45% of those items were sticky last year, and 45% of those items were declining last year. Only 10% of those items were rising. This year the trajectory has reversed. 45% is still sticky, but 45% is now rising, and around 10% is now falling. So the core breakdown, if you look into details, there are some pressures coming in, and I think the pressures are coming in not just from the housing front, but personal care, services, education. These items are going up, something to worry about for the RBI. I think on IIP, a marginal slowdown was expected on all three items, mining, electricity and manufacturing. But I think the least amount of slowdown was expected on a sequential basis I'm talking about was for the manufacturing sector. And if you try and correlate with the numbers with what, as a bank we look into credit numbers very carefully, and at a systemic level, small industries and large industries. These are the industries which are showing some uptick in terms of credit numbers. It is only the medium category which is holding things back.
Okay, fair point. As always, there are those rogue elements which kind of push the IIP up. Separators including decanters, centrifuge up to 214%. Stainless steel utensils up 158%. Bodies of trucks, lorries and trailers up 149%. Shipbuilding and parts thereof 100%, 107% actually. So some of these of course are output numbers which always skew one way or the other. But overall it does look like steel and cement have done exceptionally well, leading to a very good number for manufacturing at 8.7%. Shaumyo, manufacturing numbers?
No, I think the manufacturing numbers, we were expecting a little bit higher. So in fact, we were expecting a double-digit growth in manufacturing. But I think at 8.7%, or which you said, I think that's a pretty handy number. And capital goods number, irrespective of the base effect, even though all the months were negative last year, I think 20% growth in capital goods coupled with the infrastructure sector is actually showing that the revival which has started to happen in last couple of months back is continuing, and possibly next 1 or 2 readings should also be quite okay in terms of the IIP numbers. But having said that, I think a little bit of disappointment comes on the inflation front, because we thought that the inflation could have ebbed. The market, it is higher than the market expectations by around 10 to 15 basis points. So apart from that, I think a good set of numbers.
Okay, well, I mean, Upasna, how would you react to the inflation number at 4.3?
Well, it's higher than our expectations, Lata, almost by 20-25 basis. So clearly, we were looking at vegetable prices at about 8.6%. That's come at 11.7%. So that there itself, the food inflation has gone higher compared to what we were expecting. And along with that, of course, the core is also slightly higher. So I think all in all, from the pure, near-term trajectory, if I was to say, RBI had kind of revised down the forward-looking estimates from a 5.6 peak to a 5.1 peak.
That's right.
I think somewhere there is a risk to that 5.1, because seasonally, as we come into April and for the next 2-3 months, we know that the seasonal pattern is that the food prices are further going to go up, and there have been some kind of unseasonal rains as well, which probably are expected to disrupt some kind of supply as well. So clearly, if and then all in all, as we go ahead into June, monsoon becomes the biggest joker in the pack. We don't know exactly where we're headed to. So having said that, next 3 months we'll have to be very closely watching the numbers, because we do see an upside to the 5.1% peak that RBI has mentioned.
Actually, you're not mentioning the F word. I mean, I only meant fuel, because we have a $72 crude price staring at us. And both you and Soumya agree that you all were expecting a softer inflation number for March. That core inflation at 5.37, did you say, Soumya, is a bit of a nasty jar. All told, adding to it a $72 crude, which at some point may get passed on. Would you worry, Soumya, about the trajectory of inflation in the first half?
No, I still don't should worry, and I think that even though the inflation numbers are higher by 15 basis points, but as you know, the food prices is largely erratic. You could actually see some of the months, next month number could actually be crucial, next and April, because the peak is supposed to be reached in the June month. So if the June inflation number stays closer to 4.5%, I think that will be a pleasant number, because inflation is supposed to decline from June onwards on the base effect and other factors. So I will closely follow the next 2-month inflation numbers, but as of now, I think a 15 basis point increase should not be too much of a worry, and I still expect that the RBI projections for the first half should be substantially undershot as the RBI had laid out.
Okay. Mr. D.K. Joshi, what is your thought in terms of the core inflation hardening month on month?
Well, I think I do see if growth is going up, manufacturing is strong, that means the demand pressures are slightly picking up, and I think in that scenario the ability of producers to pass on the prices, I think, increases. So there has to be some pressure on core inflation. On top of that, I think if you look around, I think the input prices in general are under pressure. I mean, whether it is copper or it is aluminum, I think everything seems to be strengthening. So that's going to put even more pressure, I think, on some of the items that get into core computation of core inflation. So I do see pressures on inflation. And then on top of that, I think you have fuel, which is which has risen much sharper than earlier expectations. And I think with the geopolitical tension rising, there is clearly an upside to that. It's not only geopolitical tension; it's also the fact that the inventories had been coming down over the last couple of months. So I think in that scenario, a geopolitical hit creates an upside to oil. So there is a upside risk to inflation, in my view.
Oh, okay.
And also core, I mean.
Okay. Well, Tushar, now you have to come in on this and also tell us how the markets might react tomorrow. They have been edgy, not just because of inflation. There has been very little buying as well. So what might the yields do with this number?
Well, I think whatever upside risk we have discussed till now, whether it is oil or geopolitical tensions, I think the biggest joker of the pack, in my view, are the minimum support prices and the formula around it. I think RBI has taken a very, I would say not so optimistic stance on it. I think they are very much comfortable with what is happening. But I think that is one area which could be, which could pose an upside risk of around 40 to 50 basis points going ahead. And that is why, in the months to come, if RBI has a peak of 5.1%, we have a peak of around 5.5% penciled in our forecast. The rest of the items, yes, I would say the likelihood is less. Oil, we don't really know. I think it could settle down somewhere below $70 a barrel. Geopolitical tensions could be, there for short term. So rest of the items are still unlikely. But MSP, I think, is a very much likely item which can come in the equation in the months to come. Impact on the markets, I think for past 2-3 days, we have seen a big spike in bond yields. We have seen a spike of around 35 to 40 basis points. And that has, I think, not happened because of the increase in state government borrowings, which was initially the case, I think, which was prima facie everybody was thinking of. But as you said, the demand has been very weak, and this demand has been weak, I think, on account of two factors. One, the MTM losses which the banking sector is holding on their books, and secondly, the extra amount of investment which has already been done in government securities. So I think the demand is likely to remain weak, but with this number, no matter whether it is very less easing, but it has eased. I think it should be somewhat positive for the market. There should be a bit of consolidation in the near term, and not to forget, liquidity in the first quarter is now likely to improve. We have big redemptions coming in April to the tune of around 700 billion rupees. All this should be lead to a little bit of consolidation. I think 7.3 to 7.4 is the near term range where bond yields could trade around. But second half, we are still holding on to a story that the yields should pick up. Those upside risks which RBI is talking about, those upside risks might come true.
Okay. Yields are falling, inflation is falling, liquidity is plentiful, there is going to be more liquidity because of bond redemptions, but somebody is not buying because they are afraid of duration, isn't it, Soumya? Soumya, I mean, do you see bonds getting bought with this inflation number?
Yeah. I think there could be some pressure on the yields because I think the inflation numbers, the market was expecting a softer inflation number, and I think there could be some pressure on the yields in the near term.
Okay.
And hopefully, if the hopefully if the inflation numbers plays out as per the script, then there could be a positive impact. But as of now, the market will be a little edgy with the set of numbers today.
Okay, just a final quick question to you, Upasana. Because of this industrial output number, are you revising any growth number? It's a fairly decent number, you'll have to say. Last month was 7.4 and this month 7.1.
Lata, at this moment, I would like to reserve my any revisions to the numbers. We are already looking at a significant improvement in the growth for FY19, 7.1% of GVA and 7.3% GDP. So that's already a pickup, significant pickup we are looking at. So just one reading right now is not going to be adequate. Anyways, this is a reading for March. So we'll have to see how that really follows through into the rest of the year.
All right. We'll leave it at that. Lady and gentlemen, thank you very much for joining us with your thoughts. So actually, it's a divided house as far as inflation is concerned. Two of them think it's a little higher than expected, but Soumya is not terribly worried. But Dr. Joshi and Tushar and Upasana do believe that there is a slight upward tint to the inflation number. But with that, we wind up our discussion on the state of the economy. The state of the banking sector is what we are going to now discuss. The Bank Board Bureau, led by former Comptroller Auditor General Vinod Rai, has been recast. The 4-member body was formed in 2016 to improve the performance of public sector banks. Now the new chairman will be Mr. Bhanu Pratap Sharma. He was a former secretary at the Department of Personnel and Training. The 3 other members in the committee will be Vedika Bhandarkar, who was former executive at Credit Suisse, an investment bank actually, Pradeep Kumar, a former managing director, retired managing director at State Bank of India, and Mr. Pradeep Shah, the founder and managing director of credit trading agency CRISIL. I mean, that's not the only way to introduce him. He was also, in a sense, the moving spirit behind HDFC in its earliest days, and now, of course, runs a private equity fund, Indocean. Mr. Shah, thank you very much for joining us. I believe we informed you that you have been selected to the board. You didn't get an official communication?
Well, I guess I've not looked at my email, but yes, I didn't see any email till I last looked at it.
Oh, right.
So I guess we've got information now from other sources that I've been pointed also.
All right. Congratulations anyway, sir. What would your first thoughts be? What do the public sector banks need?
Well, I think the government is very serious about improving the performance of the public sector banks. They're putting in capital, and they put in the Bank Board Bureau and now recast it with the idea of improving, as it were, the governance and management of the bureau, and so of the bank. So I guess it's part of this whole program that government is engaged in, and I hope one can contribute in that process.
Well, you are associated one of the most sterling banks, HDFC Bank, which of course was founded by HDFC itself, which you were associated with. What would you borrow in terms of governance rules from a bank like HDFC Bank?
Well, you know, as every organization realizes, people make all the difference. And so having good people on board, giving them sufficient tenure to make changes or to improve things, and also bring about change in culture makes has humongous results on outcomes. So I'm hoping that that's what will happen with the public sector banks. There are brilliant people in the public sector banks, and now the attempt has to be to get them to perform and give the results that and avoid the results that we've seen in some of the public sector banks, and give the results that we've seen.
When you say longevity of tenure, what do you have in mind? Do you think 5 years is a good tenure? After all, HDFC Bank has had someone at the helm for over 25 years. The several public sector banks have had managing directors who have held at the helm for at least 10 years. What's an ideal to begin with for the public sector banks?
Well, in general, the CEO's tenure should be at least covering a cycle of lending and recovering back. Otherwise, too short a tenure does not do justice to that person nor to the bank. So I think I would prefer 5 years is, of course, better than the 2 years and 3 years that we have seen in the past. But if it is a little longer period also, there is no harm. Now that requires certain changes, and I'm sure our chairman, Mr. Sharma, will be discussing this and then thinking about it, and we will have, I guess, more opportunity to possibly contribute to that area.
Okay. Mr. Shah, your congratulations firstly. You are also coming on board at a time where we are facing NPA headwinds like never before. In your sense, do you think that maybe FY19 could be a year where we could probably hit the bottom of the barrel and then rise up when it comes to NPAs?
Well, it seems so. I think the Reserve Bank policies have uncorked the scale of the problem. And with the NCLT and the IPP, the Insolvency and Bankruptcy Board process is already being implemented, everyone is working towards resolving this NPA problem. So I guess 2019, 2020, we will see continued resolution. And certainly, I think in the next 2 years, we will see the end of the scale of the problem, and then the recovery starts.
Okay, you know, probably what has been lacking in the public sector banks so far are independent directors. You have government-nominated directors, and government is a shareholder-nominated director. Would you press for some kind of independent directors? Would that require the law to be rewritten?
No, there is already provision for independent directors under the listed for the listed banks, so that is already in place. I think I don't know what the Bank Board Bureau will finally decide. I'm just one member, but tenure and getting the right people into the banks, that means selecting them appropriately, will make some difference to the banks. And then giving them enough tenure will help change the culture in the banks. I think that culture has to be towards efficiency, towards recovery, towards serving their constituents, whether it's depositors or lenders. But at the end of the day, in a way that addresses everyone, not just giving away money to lenders and not recovering it back.
Yes, sir. Actually, we've just flashing a tweet from the banking secretary, the DFS, Department of Financial Services, Rajiv Kumar, and that tweet will come up for you again, saying that HR is what I can just read it out to you, sir. Government renews commitment to not interfere in senior level appointments in PSBs, appoints new BBB with professionals with diverse expertise. The aim is to select top management in PSBs. The BBB recommendations made so far include HR reforms agenda to be taken forward. HR reforms is something which even public sector bankers whom I have spoken to, in fact, a former chairman of SBI, deeply regretted that his bright young bankers are refusing to be in the credit committee these days. They want to do anything but credit, given the atmosphere of suspicion. Your thoughts on this? HR seems to be exactly the mandate that you will be given.
Well, I will, of course, have to, as I said, wait for our chairman to convene a meeting and then learn about finally what the BBB will do. But certainly getting the right people in, having the right culture in the bank will result in better outcomes. And I'm hoping that that will happen in the public sector banks too.
Okay, this is not a part of the BBB's agenda, I think, but would you say that bringing the government stake down below 50 would help? It will keep it outside so many government bureaucracies in terms of recruitment. I mean, you don't have to have a national exam, but if it is above 51, you have to do that. Would that be something, I mean, even if you were not a BBB member, do you think that's what is needed? Privatization in the sense of bringing down government stake?
No, the privatization can help, but it's not necessarily the only solution. We have seen public sector organizations such as the oil marketing companies doing a wonderful job. In India, for instance, we've never had shortage of oil at the pumps, unlike even, for instance, China, with all its GDP far greater than India's and per capita income far greater than India. They've had these kinds of problems. So we must recognize that public sector doesn't mean necessarily only inefficiency. It also means efficiency where the system is right. And I think that's what the attempt of the government seems to be. That putting money into the banks, have this IBBI and the insolvency laws and so on in place, enable the banks to perform as they should, and now put in good people also so that the banks move faster, the public sector banks move faster towards that goal.
Okay. Well, I'm sure you'll be bringing your valuable advice and experience to the Bank Board Bureau. Thank you very much, Mr. Pradeep Shah, for joining us. The person we have just thanked is a person who has put in place 3 sterling institutions. The moving spirit behind HDFC, and then he created the HDFC Bank naturally, as well the man who created CRISIL. So a person who perhaps is very well placed to say what works in the financial sector in India. And of course, Vedika Bhandarkar, Pradeep Kumar, bringing in diverse private sector and public sector experience, and Mr. BP Sharma, the HR experience, which apparently is what the Bank Board Bureau's mandate is going to be. Thank you very much from me and Ekta for joining this special show. Please stay tuned in. Lots more news and views follow.